I started this series to help a group of people that I'm working with get their California state life license, and that will give you access to making a lot of money with life insurance. I just want to help them get through that process. I know these videos are public. If you are interested in joining our group and making money through life insurance sales, feel free to reach out to us. You can email me at venusmediagroup@gmail.com. That's Venus, V as in Victor, mediagroup@gmail.com, venusmediagroup@gmail.com. Okay guys, day 3. Here's question 1. A life insurance policy normally contains a provision that restricts coverage in the event of death under all of the following situations except A, pilot of personal airplane, B, war, C, suicide, D, fare-paying passenger. The answer would be D, fare-paying passenger. So a life insurance policy normally contains a provision that restricts coverage in the event of death under all circumstances except a fare-paying passenger. That's right. So the insurance company can restrict paying out your policy if you die by suicide, at war, piloting a personal airplane. But if you die as a fare-paying passenger on an airplane, they cannot restrict your payout, your insurance payout. Question number 2. Mortality is calculated by using a large risk pool of people and time. So they calculate mortality by using the law of large numbers, which is a pool of people and time. Question number 3. When calculating the amount of life insurance needed for an income earner, what has to be determined when using the needs approach? A, the income earner's credit score. B, the insurance company's financial rating. C, the family's financial objectives if the income earner were to die or become disabled. D, the income earner's full projected future income. The answer would be C, the family's financial objectives if the income earner were to die or become disabled. That's what they use when calculating the amount of life insurance needed for an income earner. So if someone is the breadwinner, you want their insurance policy to replace whatever their income is in the event that something happens to them. Question number 4. Within how many days must a traditional IRA be rolled over to another IRA in order to avoid tax consequences? The answer is 60 days. So within 60 days, a traditional IRA must be rolled over to another IRA in order to avoid tax consequences. Question number 5. All of the following are examples of pure risk except A, injured while playing football, B, losing money at a casino, C, jewelry stolen during a home robbery, D, falling at a casino and breaking a hip. So all of the following are examples of pure risk except losing money at a casino. Losing money at a casino would not be considered pure risk. Question number 6. According to life insurance contract law, insurable interest exists at the time of application. So it's not something that can happen after the fact. According to life insurance contract law, insurable interest has to exist at the time of the application. Question number 7. All of these are characteristics of a universal life insurance policy except A, flexible premiums, B, flexible death benefit, C, fixed surrender value, D, builds cash value. So the answer would be C, fixed surrender value. With an index universal life insurance policy, the surrender value increases over time because you have the cash value and the compound interest. So all of these are characteristics of a universal life policy except fixed surrender value. You will not have a fixed surrender value. It will vary. Question number 8. A policy owner may change 2 policy features on what type of life insurance? A, decreasing term life. B, whole life. C, modified whole life. D, adjustable life. The answer is D. Adjustable life is the only type of life insurance that you can modify 2 policy features on. Question number 9. Which of these is affected by the frequency of an insurance policy's premium payments? A, settlement options. B, cost. C, death benefit. D, cash value. So the answer would be cost. The cost is going to be affected by how frequently you make your payments. If you pay more faster, your premiums are going to be lower, and vice versa. So the cost will always be impacted by the number of payments because they calculate your payments based on how long they expect you to live. And question number 10, which of these premium payment frequencies is not typically available to a policy owner? A, monthly. B, quarterly. C, semi-annual. D, biweekly. The answer would be D, biweekly. No insurance company that I know of thus far offers biweekly payments, but you can pay monthly, quarterly, and semi-annually and annually, of course, but not biweekly.